In the last episode, we introduced the current ratio and the quick ratio as tools for measuring liquidity. But there is a major economic problem hiding underneath traditional personal finance accounting. Most people treat rent as just another monthly expense. But economically, rent behaves much more like debt. A rent contract creates required future payments, just like debt. It's contractual obligations, just like debt. It has legal consequences for non-payment, just like debt, and ongoing claims against future cash flows, just like debt. That sounds a lot like a loan. And if that's true, then traditional liquidity ratios may dramatically overstate how financially safe someone actually is. In this video, we're going to explore why rent can be viewed economically as a liability, similar to debt, how capitalization changes the accounting, how this changes the current and quick ratio, and why this creates a much more realistic picture of liquidity. So traditionally, rent is treated very simply. Each month, we debit rent expense and we credit cash. That's it. But notice what happens economically. The future obligation completely disappears from the balance sheet, even though the individual still has contractual future payments. This creates an important problem. Liquidity ratios may appear artificially strong because a major short-term obligation is hidden. Now, instead of treating rent purely as a monthly expense, we can what's called capitalize the agreement. What this means is that we recognize a right of use asset, basically the right to use the rental unit, which gives us future economic benefit, and a matching rent payable liability. That rent payable liability represents the obligation that we have in the short term to make rent payment, just like a loan. So if we assume that monthly rent is $2,000 and we have 12 months that remain on the lease, the initial entry becomes to debit our right of use asset for $24,000, which is the 12 months times the $2,000 per month, and credit the rent payable liability for the same amount, $24,000. Now the balance sheet reflects the future obligation. This is economically similar to recognizing, say, the current portion of a car loan, equipment financing, or the current portion of a mortgage obligation. At this point, we should quickly review current and non-current classifications. Current assets and liabilities are expected to be used or settled within 12 months. Non-current items extend beyond 1 year. Since this example only has 12 months remaining, the entire rent payable is classified as current. The right of use asset is going to be classified as a non-current asset or a long-term asset. And this is where liquidity ratios begin changing dramatically. Now let's deal with the monthly accounting adjustments. Each month we record two entries. First, we recognize economic value consumed during the month. We're going to debit our depreciation expense. This is the depreciation expense that we realize for the use of the asset. And we're going to credit our accumulated depreciation account attached to that right of use asset. Notice something important. We are no longer recording rent expense directly. Instead, the right of use asset is being consumed over time. Second, we record the payment itself. We debit our rent payable liability, essentially drawing that down, and we credit cash for $2,000. Economically, this behaves similarly to repaying principal on a loan that has zero interest. Now we move to the cash flow statement. Net income includes depreciation expense, but depreciation is non-cash. So in cash flow from operations, or for our personal finance, cash flow from daily living, we add depreciation back, just like we add depreciation back for a car. Then the actual rent payment appears in cash flow from financing activities. Why? Because economically, the payment behaves similarly to repaying debt principal. This creates a major conceptual shift. Under this framework, rent is no longer treated purely as a daily living operating expense. It behaves more like financing activity. There's another important economic insight here. Technically, the rent liability amortizes downward over time. But economically, month-to-month rent rarely truly disappears. Most rental agreements require notice periods. For example, a 60-day notice requirement effectively creates an ongoing rolling obligation. So economically, the liability continuously renews. In reality, the obligation rarely falls to zero. To simplify, we can think of the system in two phases. Phase 1, no notice has been given. In this simplified framework, we simply expense rent directly each month. Okay, once we've completely depleted down to that 60 days or 2 months value of the right of use asset and the rent payable. We're going to debit rent expense and we're going to credit cash simply, okay, but only once we get to that value. Phase 2, notice has been given. At this point, the remaining contractual obligation becomes finite and measurable. Then we transition into the right of use asset, accumulated depreciation, and the rent payable framework, which we've been using from the time before that 60-day period. This keeps the system practical while still capturing the economic logic. So now let's see how this changes liquidity ratios. Before capitalization, assume that we have cash of $8,000 and credit card debt of $2,000. That's it. So our current ratio is going to be our current assets, which is $8,000, divided by $2,000, which is our current liability, or 4.0. Our quick ratio is also 4.0 because we only have cash as the asset. At first glance, this individual appears extremely liquid. But now let's capitalize rent. If we assume 12 months remaining, $2,000 monthly rent, that creates a $24,000 current rent liability. Now total current liabilities become $26,000. If we take our current ratio, 8,000 divided by 26,000, this equals 0.31. And again, the quick ratio is also 0.31. Nothing changed economically. The person already owed the rent. Only the accounting treatment changed, but suddenly the liquidity ratio tells a completely different story. And arguably, this is a much more realistic one. Now here's the important part. Capitalizing rent may reveal a much weaker liquidity position, but visibility is not the enemy. Visibility creates better decisions. Let's see what happens when we strengthen liquidity directly. Assume the individual builds a $6,000 emergency fund. The current assets now increase from $8,000 to $14,000. Current liabilities remain at $26,000, let's assume. Now let's recalculate the ratios. The current ratio is $14,000 divided by $26,000, which equals approximately 0.54. Quick ratio also increases to approximately 0.54. Notice what happened. The ratios are still below 1.0, but liquidity has materially improved. And this is where emergency funds become extremely important. An emergency fund does not eliminate obligations. What it does is increases financial flexibility, it increases survival capacity, it reduces dependence on financing, and very importantly, creates psychological stability. That last point matters more than most people realize. When liquidity is weak, small disruptions feel catastrophic, unexpected expenses create panic, and financial stress compounds emotionally. But stronger liquidity changes behavior. It allows people to think more clearly, make less reactive decisions, avoid desperation borrowing, and tolerate short-term uncertainty. In other words, liquidity is not just mathematical, liquidity is psychological resilience. And that resilience becomes even more important once we fully recognize the true obligations sitting underneath a household financial structure. Notice something else. Nothing changed about the liabilities. The obligations were already there. What changed was the cushion protecting against them. That cushion is what an emergency fund really is. Not wealth, not investment returns, not growth, just protection. And once we understand liquidity, visible obligations, and financial resilience, we can begin asking an even bigger question. Not just, can I survive the next 12 months, but am I structurally building long-term financial strength? And that takes us directly into solvency.